Welcome to The Explainer. Today, we're going on a pretty wild micro to macro journey. We're going to look at how tiny, almost invisible quirks in the human brain actually scale up to cause massive financial market anomalies, and ultimately force entire governments to rewrite the rules of regulation. Okay, let's dive right into this. Here's our roadmap for this explainer. First, heuristics. Are they just shortcuts or actual errors? Second, we'll look at the big three biases. Third, the three forms of overconfidence. Fourth, correlated errors in market limits. And finally, outcome-based regulation.
Section 1. Heuristics, shortcuts or errors. So let's start with a foundational question. When our brains make quick, snap judgments, are we just making dumb mistakes? Well, not quite.
Think of a heuristic as a mental rule of thumb. It's an adaptive cognitive tool. According to the ecological rationality view, these heuristics aren't just flawed approximations of some perfect calculation. They're actually optimal responses to the natural environments we evolved in. They produce good enough answers quickly so we can, survive. The real problem arises when we take these highly calibrated natural tools and drop them into incredibly complex artificial environments like modern financial markets or legal settings or insurance pricing. That is exactly when they misfire and create systematic errors.
Moving into Section 2, the big three biases. Let's see how this builds into the core psychological mechanisms that actually trip us up. We're going to look at the big three: representativeness, availability, and anchoring.
First up is representativeness. When we try to figure out if object X belongs in category Y, our mind simply asks, hey, how much does X resemble a typical Y? So if a company has 4 consecutive quarters of strong earnings, it looks like a successful business, right? As a result, an investor might blindly extrapolate that growth forward, completely ignoring the statistical reality that extreme performance almost always reverts to the mean. We get totally mesmerized by the prototype and we just ignore the base rate.
And this brilliantly illustrates the exact failure mode. This is Bayes' theorem, the mathematically correct way to assess how likely a hypothesis is given some new evidence. Look over at that part on the top right, P of H. That's the prior probability, or the base rate. Representativeness causes us to hyperfocus on the vivid diagnostic evidence, how much something looks like that prototype, and we severely underweight or literally discard that base rate.
Let's put this math into perspective with the real-world loan default screening model. Imagine 10,000 applicants where the underlying default base rate is super low, just 4%. Now the bank's model seems great at first glance. It flags 80% of future defaulters, but it also has a 10% false positive rate. If an applicant gets flagged, our representative mind sees that 80% accuracy and assumes, wow, this person is highly likely to default. But do the math here on the slide. Because the base rate of safe applicants is so huge, the pool of flagged people is totally dominated by false positives. The actual true probability of default for a flagged applicant is only 25%. Ignoring the base rate here doesn't just create a little cognitive error, it creates a massive failure in risk assessment, shutting out a huge swath of perfectly creditworthy borrowers.
Our second big hitter is the availability heuristic. This is assessing probability based on how easily examples pop into your mind. If it's vivid, if it's recent, or if it's heavily covered by the media, it just feels more probable. In financial markets, this actually solves a massive search problem. Retail investors have to choose from literally tens of thousands of stocks. How on earth do they pick? Well, research shows they become net buyers of attention-grabbing stocks, companies with huge single-day moves or heavy news coverage, simply because those options are cognitively available to them.
Just take a look at this stark contrast here, comparing perceived versus actual mortality. Dramatic events like tornadoes, floods, and homicides are vastly overestimated. Why? Because they bleed all over media headlines. Meanwhile, incredibly common but quiet killers like asthma, diabetes, and stroke are severely underestimated. This directly explains why the demand for earthquake or flood insurance irrationally surges immediately following a disaster, literally right when the premium represents the absolute worst value, and then just decays during the quiet periods.
Bias number 3 is anchoring. This is our natural tendency to start with an initial reference value and then adjust from there. And the truly shocking part? It persistently fools even the experts. In one study, experienced real estate agents were heavily influenced by a totally arbitrary listing price when valuing a home. In an even more stunning experiment, highly experienced judges rolled a pair of rigged dice before sentencing a hypothetical defendant. Get this, judges who rolled a 9 gave sentences averaging 7.8 months. Judges who rolled a 1 gave sentences averaging 5.3 months. A completely meaningless number literally anchored human freedom. The absolute crux of the problem is right here in this inequality. Your estimate equals the anchor plus your adjustment. We do adjust for sure, but the adjustment is systematically insufficient. The absolute value of our adjustment is almost always less than the actual gap between the truth and the anchor. Why does this happen? Because we stop adjusting the exact second the answer feels plausible. And unfortunately, that initial random anchor has already completely hijacked our subconscious sense of what plausibility even feels like.
Tversky and Kahneman's famous 1974 experiment captures this effect perfectly. They asked people to estimate the percentage of African countries in the UN, but right before that, they spun a completely meaningless wheel of fortune. For the folks where the wheel landed on 10, their median estimate was 25%. For people where the wheel landed on 65, their median estimate jumped to 45%. That is a massive 20 percentage point gap driven entirely by an obvious, randomly generated anchor. It's wild. Section 3. 3 forms of overconfidence. Let's transition from how we process information out in the world to how we actually view ourselves. Overconfidence isn't just one big monolithic flaw. It's a family of related cognitive traps.
There are 3 main forms here. First, overestimation. That's thinking your absolute abilities are better than they really are. Then there's overplacement. This is that statistical impossibility where basically everyone believes they are above average. But the most lethal form in finance is overprecision, being far too certain that your beliefs are correct and drawing confidence intervals that are way too narrow. Overprecision drives excessive trading, especially among single men, as research by Barber and Odin showed, which absolutely crushes their net returns. It's also the root cause of M&A hubris, where overconfident acquirers systematically overpay for target companies based on overly precise estimates of future synergy.
So all of this begs a massive question. If we're all just running around making these predictable mental errors, shouldn't rational, highly sophisticated institutional traders just exploit our mistakes, take our money, and correct the market prices? Don't these individual biases just wash out in the end?
Section 4. Correlated errors and market limits. To answer that question, we really have to zoom out to the macro level and see how these quirks actually scale up within financial markets.
The whole efficient market defense relies on errors being random. Think about it. If half of us are foolishly optimistic and half are foolishly pessimistic, it's just noise, right? It cancels out. But heuristic-based errors are not random, because we all share the exact same cognitive architecture and we're all exposed to the same environmental inputs, like watching the exact same dramatic financial news. Our biases correlate. We all extrapolate the same trend at the same time. We all panic over the same highly available media story at the exact same time.
And what about those rational arbitrageurs just waiting to fix the mispricings? Well, they face severe limits to arbitrage. Fighting a massive wave of correlated irrationality is incredibly expensive and dangerous. Short selling comes with high costs. There's also noise trader risk, meaning irrational sentiment can push a price much further away from reality before it finally corrects. And frankly, a fund manager faces huge career risk if they take a contrarian position that underperforms for years while waiting for the market to wake up. They could easily get fired long before they're proven right.
Section 5. Outcome-based financial regulation. This brings us to our systemic finale. If humans have these deeply baked-in biases and the market can't automatically correct them, how do we actually protect people? The answer is, we have to change the rules.
For decades, the go-to regulatory fix was always just more disclosure. Give the consumer a 50-page packet of fine print. But as this explainer has hopefully shown, a lack of information usually isn't the problem. Cognitive bias is the actual binding constraint. If a highly trained expert judge can be anchored by a literal roll of the dice, handing an everyday consumer a perfectly accurate disclosure document that happens to have a strategically placed arbitrary anchor price on page 1, that's not going to save them. They are still going to be manipulated. This exact dynamic is why governments are finally shifting gears. The UK's 2023 Consumer Duty is a prime example of this. It represents a massive pivot toward outcome-based regulation. Regulators are essentially stepping in and saying, look, we acknowledge that humans are boundedly rational. Therefore, financial institutions can't just hand over a dense disclosure form and wash their hands of the whole thing. You must actually prove that your product design, your framing, and your pricing result in genuinely good outcomes for these predictably biased consumers. It is a fundamental, game-changing shift from regulating the information to regulating the environment itself.
Which leaves us with a final, really vital thought to consider. Think about the platforms you trade on, the insurance policies you buy, or maybe even the company you work for.
You now know the mental shortcuts that we all rely on. So, take a look around. Is your institutional environment designed to help correct these cognitive biases, or is it quietly designed to exploit them? Something to chew on. Thank you so much for joining me for this explainer, and I'll catch you next time.